If you've ever heard someone say your practice is worth a multiple of EBITDA, you might assume EBITDA is a fixed number. It is not. In dental practices, EBITDA can be calculated very differently depending on who is buying your dental practice. And misunderstanding that difference can cost you a lot of money or create very unrealistic expectations. So let's break it down. Let me introduce myself. I'm a dental CPA working with dentists across the country providing bookkeeping services. On this channel, we share practical, numbers-based tips to help dentists increase profits, reduce taxes based on what actually happens inside the real dental practices. Today, we're talking about a term that gets thrown around a lot, and it's often misunderstood in dentistry. So, let's break it down. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. In simple words, EBITDA is meant to show how profitable is the business before financing decisions, before tax strategies, before non-cash expenses. For most businesses, EBITDA is fairly standardized, but dentistry is just a bit different because the owner is often also the main producer. That's where things get a little tricky. In a dental practice, the owner usually owns the business, produces dentistry, gets paid in some form of salary or draw. So the big question becomes, is the owner's compensation an operating expense or part of the profit? And the answer depends who the buyer is. Let's start with the DSOs. When a DSO evaluates your practice, they assume you may stay on temporarily or you may leave. Either way, they need to replace your clinical production. So, what do? They normalize the owner doctor's compensation. This is what it means. They remove what you actually paid yourself and replace it with a market rate associate dentist salary. For example, your practice generates $600,000 of profit before owner pay. You paid yourself $400,000. A DSO may say an associate would cost us $250,000. So they adjust the EBITDA by adding back your $400,000 and subtracting $250,000. That adjusted number is the EBITDA they value the practice on. This is why DSOs and owners often talk past each other. They're not using the same EBITDA. Now, let's look at dentists buying the practice to work in it. In this case, the buyer is the producing dentist. There is no need to replace the owner. So what happens? The owner doctor's compensation is not treated as an expense. It's considered the buyer's future income. So when calculating EBITDA for buyer dentist, owner salary is usually excluded because the buyer expects to earn that money themselves. This often results in a much higher EBITDA number compared to a DSO calculation. Same practice, different buyer, and hence different EBITDA. This difference matters a lot because practice value is often a multiple of EBITDA. A small change in EBITDA can make hundreds of thousands of dollars worth of difference. If you don't know which EBITDA you're talking about and who it's being calculated for, you can easily overvalue your practice, undervalue your practice, or completely misunderstand an offer. EBITDA is not wrong. It just needs context. So here's the takeaway. EBITDA for dental practices is not one size fits all. It depends on who is buying, how the owner's compensation is treated, and what assumptions are being made. If you're selling, buying, or planning long-term, You need to understand which EBITDA actually applies to you. If you want more real-world insights into dental practice numbers, profits, and taxes, subscribe to our channel. And I'll see you in the next one.